Yeah, as you know that the Reserve Bank has raised its growth projections. Of course, it has cut its rate, and you are right. Inflation is at in the current series it's at the lowest level, and the GDP number which came 8.2% was a bit positive surprise, I would say. And you also mentioned about nominal GDP. Uh, the MOSPI uses WPI to deflate the real nominal numbers with to get the real GDP, and WPI is also has so much it has so much weight insofar as commodities are concerned. So when oil prices go down, then wholesale price index comes down, and when you deflate the nominal value to get the real values, then the GDP comes down. So opposite happens when the oil prices go up. So one of the reasons for 8.2% real GDP is because of no low nominal low deflator, and I believe it's a temporary thing. But even if you discount nominal GDP deflator, but I think still the growth is quite healthy, and we should be able to maintain that. I won't say that it would be possible to sustain a very high growth rate, but I think growth around 7.58%, if we get it in the coming few years, and that would be quite positive. Yeah. And insofar as rupee is concerned, that I think we should not attach too much value to the nominal rupee exchange rate. We should go by a real effective exchange rate. If Indian rupee is declining, and if other currencies are also declining, then we should not be losing our competitiveness. I think we should always look at real effective exchange rate, and if you go by that, I think we should be okay. So let's not give too much weightage to the nominal exchange rate. Yeah. Yeah, no, you are absolutely right. Inflation target is 4%. That's a central target, and then we have tolerance band of plus minus 2%. There was some period after the COVID when inflation breached the upper tolerance band, and it was above 6% for many months, and now it has gone below 2%. And one of the major reasons for this is because of low food inflation. And because of low food inflation, but even if you take core inflation, though the core number is 4 point something, I believe 4.3% or so, but if you take out precious metal inflation like gold and silver, then the inflation is below 4. Core inflation is below 4%, and it has remained there for quite a number of months in the last, which is not a good thing, I would say. So the Reserve Bank has now statutory responsibility to keep the inflation close to 4%, but it's not always possible to do that. And but in order to spur inflation, to drive inflation up, the Reserve Bank has cut the rate. In fact, this is the major reason. Growth was not much of a concern, where growth came to 8.2%. But since inflation was low, keeping in mind its mandate of that it has to have inflation close to 4%, it has cut the policy rate. That's the only tool Reserve Bank has to drive up the inflation, which it has done. Of course, it has also injected liquidity into the system. The whole idea is that when you cut the rate, then there should be core inflation should pick up. There would be greater economic activity, and core inflation should pick up. By the way, food inflation, it's not under Reserve Bank control. The Reserve Bank can take up only core inflation up. So that's the whole objective of cutting the rate, and I'm sure with this there should be increase in the inflation rate. Again, I think they have their own way of making projections, and we have our own way of making projections. Sometimes these projections diverge. If you see in the past, there are many occasions when IMF projections were higher than ours. So it's possible, and it's quite okay. There's no problem. And since they have their own methodology, we should live by that. That should be fine. Yeah. No, so let me give you the background first as to why we introduced external benchmark lending rate, what we call EBLR. When the Reserve Bank cuts the rate, the rates are cut basically to prop up the economy, because aggregate demand is low, and then you spur aggregate demand in order to achieve high growth. But what we had seen in the past, banks were not passing that whatever Reserve Bank, whenever the Reserve Bank was changing its rate, particularly when it was cutting down the rates, banks were not passing those rates to their borrowers. So as a result, the transmission was significantly impaired. And though we impress upon banks from time to time that they should help us in getting better transmission, but that was not happening. So by introducing external benchmark link rate, we basically reverse the whole process. Earlier what was happening, banks will first reduce their deposit interest rates, then they will reduce their lending interest rates. But by now linking the lending rates to the external benchmark, and they have to reset the rates, you know, as and when their ALMCs meet, which is normally in a month or so. So as and when the Reserve Bank cuts the rate, and when their next asset liability management committee meets, they will have to cut the rate. So what would happen? They will have to cut the rate, and then it takes some time for them to cut deposit rates. That's why their margins sometimes they come under pressure. But I think that will be a very, very short-term phenomenon. Sooner or later, you will find that banks will, since they have cut their lending rates, they will have to cut their deposit rates also. And deposit rates, we should always, deposits and lending interest rate, we should always look in real terms. Since inflation is very low, so real interest rates are still very positive. So we should not look at the nominal rate. And in any case, nominal interest rates have cycles. So I think it's perfectly fine. Banks' margin may be under pressure for some time, but they should be fine. Let me also tell you, some of the banks are enjoying very high NIMs, like NIMs as high as 5%. I think it's unreasonable for banks to have such high NIMs, 4 to 5%. If you find public sector banks, their NIMs are around 2 to 2.5%. But many private sector banks have very high NIMs. So it's not a sign of your efficiency. So I would say that they should have reasonable NIMs. It's okay to have up to 2 to 2.5, 3% maximum. Yeah.
So 2.5 to 3% is the optimal NIM.
Normally it should be 2%, 2.5%, but up to 3% also should be fine. But not like 5%, 5.5%, which many banks.
What are the problems that a higher NIM poses?
See, it's basically you are preferring one set of borrowers and depositors, and another set of your stakeholder is the shareholders. So if you have high NIMs, that means either you are paying less to your borrowers, or you are charging more to your lenders. So since banks are public listed entities, they want to be much more profitable and then enjoy good valuations. That's okay. But I would say that 5% NIMs are very high, and I would say that they should not be allowed to have this high NIMs.
Sure, sir.
They should pass on that benefit to either to their borrowers in terms of low lending rates, or to the depositors by paying them higher interest rates. They are basically preferring that their shareholders over their borrowers and lenders with which they run their business basically. Many public sector banks which have very healthy balance sheets and large balance sheets, their NIMs are not. I don't come across any public sector bank which has NIM more than 3%. I think mostly they are in the range of 2 to 3%. But there are some private sector banks which have very high NIMs. I think it's not advisable to have such high NIMs from operational point of efficiency point of view. CASA is a low cost source of funds for banks because they don't pay any interest rate on current accounts, and they pay very small rate of interest on saving deposits. Actually, we had deregulated the saving deposit interest rate. This was the last interest rate to be deregulated. But you see, most of the banks, they are still not changing their saving deposit interest rate as they should be changing.
Yes.
And they have been, it's like, some sort of, what should I say, there is some understanding as if they should not raise saving deposit interest rate, because then they will lose their source of low cost funds. But I think, and because of them, some banks are able to enjoy very high NIMs. But I think 40-45% banks are clamoring to increase the share of CASA. There is limit to that. and some banks have as high share as 45, 50%. It's okay. See what happens, no, why they are getting higher CASA share? It's mainly because the term deposits are moving out of the system. They are getting deployed in like, instead of going to deposit, banks are now putting money in equity, in the equity market. So money comes back to the system in some form or the other. So but it doesn't come back to the banking system in the form of deposits. It comes back to the banking system in the form of current accounts and saving. That's how the CASA share has increased over the years. But I think 40-45% is a reasonable number, and banks, of course, they will try to have more low cost deposits, but it also exposes them to a risk, because of course there is a part of the CASA deposit which is which you can call it a core component which always stays with the bank. So but I think it's okay if in a particular quarter or 6-month period some CASA share comes down. I don't see any harm in that. Now coming to your second issue, as the economy matures, good corporates which are able to raise money from the capital market, they will go to the capital market. But you have pie which is also expanding. Over a period of time, if you see the share of retail loans, it has increased in banks' loan book. I believe it would continue to happen for some more years. So all those corporates which are well rated and which they can access capital and bond market, they will go there. But there are other borrowers apart from retail borrowers. There are also small and medium industries which can't go to the capital market. There are some other borrowers also which, for some reason, for strategic reason, for their own the business model point of view, they would like to go to the banking sector. So that's okay, there's no problem. But I don't think it's going to hurt them, the banks. Actually, I would take it a bit positively. I would say it's a good thing, because if banks have more retail loan portfolio, then banks are exposed to less credit risk. Like if one big corporate going bust or not able to repay bank loans, then that has huge impact on banks' profitability and balance sheet. Whereas if small retail loan borrowers, they default, I think banks can take that in their stride. So I'm viewing it as a positive development, and we should not worry about that. Yeah, no, first of all, saving deposit, I don't, absolutely, there's no need to go back and regulate the saving deposit interest rate. But I would like to make a point here. If banks had been increasing the saving deposit interest rate in line with their other deposit interest rates, then now they had the room to cut saving deposit interest rate. Since they have not raised it, so there's no room. That's another point which I want to highlight, is that banks should change all their interest rates, including saving deposit interest rate, when the interest rate go up. But when interest rates come down, then they should reduce all their interest rates, including saving bank deposit interest rate, because that's how banks can be flexible, and they can be nimble to move interest rates in both directions as and when the monetary policy makes them to do. So one of the reasons why they are not able to reduce the saving deposit interest rate, because it's already low and they don't want to lose their saving deposit holders, because this is one of their source of low cost funds, as I mentioned. Yeah, second point I missed it.
Sir, on the retail, unsecured retail
Yeah, no. See, most of the retail loans are also secured loan. See, if you see the retail loan portfolio of banks, quite a sizable chunk comes from the housing loans, which are all secured. No bank gives a loan without having collateral in the form of property sale deed. And there are maybe some unsecured loan, particularly vehicle loans, etc. But again, I think they have mechanism to ensure that they get their money back. So I'm not much worried on insofar as banks are concerned, because most of the loans are secured insofar as retail investors are concerned. I think there was some issue with regard to NBFCs earlier, about which the Reserve Bank then had taken action. Yeah. You see that if you are talking about the regular announcements, so what we call them developmental regulatory policy measures, which were basically always a part of the monetary policy. Whenever monetary policy was issued, this was used as a opportunity, as an opportunity to issue other regulatory and developmental measures. They were not related to monetary policy. They were independent of that. But that's how things had evolved. So yes, you are right. Governor Shri Malhotra ji announced many measures in his the October policy, which was announced. Then also some measures have been announced in December. So it's an ongoing process. You keep taking, you keep examining various issues from time to time. Then the issues which need immediate attention, then you take either you tweak them, you modify them, or you introduce new measures. It's a part of regular Reserve Bank policy. So there's nothing surprising about that. But one measure which attracted my attention, which is very significant, which I must point out, is the now deposit insurance, the premium which banks pay. Now, as of now, banks pay flat rate premium to the deposit insurance and credit guarantee corporation. Our deposits are insured up to a limit. So now all banks pay the same amount of premium irrespective of the degree of their soundness. But now what the bank has come, it will be risk based. Like banks which are more sound, they will pay less premium, and the banks which are not as sound as other banks are, they'll pay more premium. So instead of paying flat premium, banks will be paying differential premium, which I think it's a very good thing. It was due for a long time. I expected actually long time back that this will be introduced, but for some reason perhaps it was not possible to do that. Now that it has come, I welcome that. It's a very good thing. You should not be penalizing. It's not a penalty as such, but banks have to insure their depositors. So you by charging the same premium at a flat rate, you are basically penalizing banks which are much more is sound than other banks. So I think it's a good thing which the Reserve Bank has done, and I wholeheartedly support that. No, I think this, and again I would come to the same point. This is an ongoing process. As and when the issues arise, action is taken. One area which the Reserve Bank, of course, has done, like they have, since we are all facing climate change risk, in the coming year, the Reserve Bank may have to take more measures in order to ensure that banks protect themselves from the credit risk arising out of, Reserve Bank has already made banks to disclose their portfolio which is at risk. But I think this is one area which will continue to engage the Reserve Bank in the coming years, whereby banks are protected. And the Reserve Bank may also introduce some more measures in order to deal with the climate change which is happening and which we can experience on a day-to-day basis.